Before discussing money, we need to address something that appears unrelated but is deeply connected. Acquiring wisdom is a moral obligation, not merely something done to advance in life, but a necessity. There is a related truth that matters greatly. It means you are committed to lifelong learning. Without lifelong learning, you will not perform very well, and you will not progress far in life based on what you already know. That point is worth repeating. You will not get very far based on what you already know. Most people complete their formal education and effectively stop learning, consuming news, scrolling social media, watching videos like this, but never deliberately acquiring wisdom. The wealthiest investors I have studied operate like learning machines, ending each day slightly wiser than when they began. Over a long period of time, that habit compounds into something extraordinary. What I have observed over time is that people who rise in life are not always the most intelligent, and sometimes they are not even the most hardworking. What they consistently are is learning machines who improve a little every single day. I have never known a wise person across a broad range of subjects who did not read constantly. Not one. If you are not committed to continuous learning, nothing else I say will help you, because you will hear it, nod along, and return to doing exactly what you have always done. The first step to never being poor again is accepting that you do not know enough and committing to fixing that for the rest of your life. The most powerful force in finance is not a secret investment strategy, not cryptocurrency, and not real estate flipping. It is compound interest. Understanding both the power of compound interest and how difficult it is to achieve lies at the core of understanding many things. Now for the mathematics, because this is where most people mentally check out, and that disengagement is precisely why they stay poor. Imagine this situation. You have an investment that compounds at 15% per year for 30 years. At the end, you pay 135% tax on all gains. After taxes, you keep roughly 13.3% per year. Now consider an alternative with the same investment and the same 15% return, but you pay taxes each year at 35% of your gains. Your return drops to 9.75% per year, a difference of more than 3.5% annually. Over 30 years, that 3.5% gap becomes devastating, marking the difference between retiring wealthy and retiring anxious. The tax system gives you a massive advantage if you can find investments you can simply hold. This is why wealthy people remain wealthy. They understand that the first rule of compounding is never to interrupt it unnecessarily. Every time you sell an investment to chase something better, you trigger taxes, reset the compounding process, and incur transaction costs. Statistically, the new investment is unlikely to be superior anyway. The real money is not made in buying and selling. The real money is made in waiting. Most people cannot wait because they become bored. They become frightened. They notice something shiny, and that is when they disrupt the most powerful force available to them. A small number of good decisions made over a long period can lead to extraordinary results. You do not need 100 good decisions. 5 or 6 are enough, combined with the patience to allow them to work. Now comes an uncomfortable truth that must be stated. The first $100,000 is extremely difficult to accumulate, and there is no shortcut around this. It requires sacrifice, which may mean walking instead of driving or never eating anything that was not purchased with a coupon. Whatever it takes, you must find a way to reach that first 100,000. After that point, you can reduce the intensity slightly. Why does this number matter so much? Below 100,000, compounding does not have enough weight to make a meaningful impact. The returns exist, but they are small in absolute terms. 10% of 10,000 is 1,000, while 10% of 100,000 is 10,000. Same percentage, vastly different life effect. This is the part most people refuse to accept. There is a phase of accumulation where you must grind, spending far less than you earn, taking the difference and investing it sensibly. You repeat this month after month and year after year until you reach critical mass. Put your savings into tax-deferred accounts, and over time it will grow into something substantial. This is so obvious that failing to do it amounts to self-sabotage. Yet most people still do not do it. They earn money and spend it. When a raise arrives, they inflate their lifestyle. Then they reach 50 or 60 with almost nothing saved, wondering what went wrong. What went wrong is arithmetic. They violated the fundamental rule. Spend less than you earn. Always save something. This leads to inversion. Instead of asking how to become rich, ask how to ensure you never go broke. Smart men go broke in 3 ways: liquor, ladies, and leverage. The first 2 are listed because they start with the same letter. The real danger is leverage. Leverage means borrowing money to invest. It sounds sophisticated. It sounds intelligent. And in rare cases, used sparingly by people who truly understand it, it can work. But for most people, most of the time, leverage is how a temporary setback becomes a permanent disaster. The reason is simple. There is no such thing as a completely certain investment, which makes leverage dangerous. A sequence of excellent numbers multiplied by 0 will always equal 0. That point deserves emphasis. A sequence of excellent numbers times 0 equals 0. You could achieve 20 years of 15% returns and appear to be a brilliant investor. But if you are leveraged and year 21 delivers a 50% drawdown, you are wiped out, not delayed. Completely wiped out. Do not assume you will get rich twice. The ideal strategy is to borrow in a way that no temporary disruption can harm you. Better still, avoid borrowing altogether. One of the most successful companies ever built was created without leverage, even though its leaders acknowledged they could have doubled their results by using it. The opportunities were clear, and the returns were available. They chose not to do it. The reason was simple. The idea of disappointing people who trusted them, shareholders who entrusted them with their savings, was unacceptable. Losing 75% of the money would not have ruined them personally, but it would have devastated many shareholders. That level of maturity is rare. Most people see only the upside of leverage. They ignore the human cost of the downside. Now bring this closer to everyday life. Once you fall into debt, escaping it is extremely difficult. Never carry credit card balances. You cannot get ahead while paying 18% interest. This is basic arithmetic that millions of people ignore. If you are paying 18% on credit card debt, you must earn 25 to 30% on investments just to break even after taxes. No one earns 25% consistently. Not the greatest investors, not anyone. Every dollar on a credit card is a dollar actively working against you at a rate you cannot defeat. Before investing anything, before thinking about stocks, real estate, or starting a business, eliminate all high-interest debt. This is not optional. It is the foundation upon which everything else rests. Now we turn to thinking itself. You cannot truly understand anything if you merely memorize isolated facts and repeat them. If those facts are not connected to a structured framework of theory, they are unusable. You need models in your mind, and you must organize your experiences, both indirect and direct, within that framework. In practical terms, this means understanding multiple disciplines, not just finance, but psychology, mathematics, history, biology, economics, and engineering principles. Reality does not respect academic boundaries. The world is interconnected. A business decision may require understanding human behavior, statistics, historical trends, and competitive forces simultaneously. If you rely on only 1 or 2 mental models, human psychology will push you to distort reality so that it fits those models. This is why specialists often make poor investors. They interpret everything through a single lens. The real estate specialist sees every solution as a real estate deal. The technology specialist sees every opportunity as a technology play. The truly important ideas carry most of the weight. Learning the major ideas from all key disciplines and making them part of your mental habits is not difficult. Once you know them, they are useless unless you practice applying them. Without an effective method of learning, you are severely handicapped. The insight that separates wealthy individuals from everyone else is surprisingly simple. People gain enormous long-term advantages by trying to be consistently not foolish, rather than trying to be exceptionally intelligent. Most people aim to be clever. They want the smart trade, the brilliant insight, the investment that makes them look impressive in conversation. Those who actually build wealth are playing a different game. They ask what the most foolish action would be and how to avoid it. A practical method is this. Before making any financial decision, list 3 or 4 realistic ways it could completely fail. Not unlikely fantasies, but genuine ways you could lose most or all of your money. If you cannot afford that loss, do not make the decision. It really is that simple. This method is known as inversion. Instead of focusing on how to succeed, focus on how to fail, and then avoid those actions. The common paths to failure are well documented. Excessive leverage, consumer debt, chasing past performance, panic selling, buying things you do not understand, and trusting people whose incentives conflict with yours. Avoid all standard paths to failure. Avoid irrational behavior at all costs. Irrational behavior is far more common than most people realize. It is easy to fall into it. Just stay away from it. One final personal note on why wealth truly matters. The objective is not luxury cars. It is not status symbols. It is not impressing other people. The objective is independence. There is something profoundly satisfying about the independence of a capitalist, solving problems, making calculated bets, preferring to make your own decisions, and risking your own capital. When you work for someone else, you operate on their terms, their schedule, their priorities, and their judgment of what you are worth. When you possess capital, when you own assets that generate income, you gain choices. You can leave bad situations. You can wait patiently for good opportunities. You can refuse things that do not benefit you. The original aim was independence. Some people simply overshoot the target. That is the correct way to frame it. The objective is not wealth for its own sake. The objective is freedom. Wealth is merely the instrument that purchases freedom. The beautiful truth is this: you do not need billions to be independent. You need enough so that your basic needs are met without exchanging your time for money. For some, that number is 1 million. For others, it is 3 million. For a few, it is less. But you will never reach it if you spend everything you earn. You will never reach it if you disrupt compounding. You will never reach it if you use leverage and destroy yourself. Now we turn to where to invest capital once you have it. Focus on areas where you hold an advantage over others. Do not compete in games where others are wise and you are ignorant. Seek situations where you are knowledgeable and others are not. You must understand the limits of your own competence. This is known as the circle of competence. Most people have no idea where their circle ends. You know you are inside it if you can explain why something works, what could go wrong, and what would cause you to change your mind. If you cannot do all three, you are outside your circle. High intelligence does not protect people from being poor investors because temperament matters more than intellect. Patience, discipline, and the ability to endure losses and adversity without losing control are essential. A small circle of competence combined with poor temperament produces disaster. A larger circle of competence combined with good temperament produces wealth. The uncomfortable reality is that for most people, the best investment is the simplest one. For average investors, the rational choice is index funds. That is not exciting. You want to hear about secret strategies, but the evidence is overwhelming. Most professional money managers fail to outperform the indexes over long periods. After accounting for fees, perhaps 5% add value. Everyone else is in denial. If professionals with full-time research teams cannot beat the index, there is no reason to believe you can. The honest solution for most people is to invest in diversified index funds, keep costs low, avoid panic selling, and allow compounding to work for 3 decades. It is not glamorous, but it is effective. Since professional managers are mentioned, something about the financial industry deserves attention. Many money managers are little more than fortune tellers or astrologers. That may sound harsh, but it is accurate. Consider incentives. Money managers are paid based on assets under management. More assets mean more fees. What do they focus on? Asset gathering, marketing, and storytelling. Beating the market is difficult. Gathering assets and collecting fees on slightly underperforming portfolios is much easier. Show me the incentive and I will show you the outcome. If someone is incentivized to collect your money and charge fees, that is what they will do. Whether it benefits you is secondary. This is not because financial professionals are immoral. Many genuinely believe they are helping. Belief does not change arithmetic. And the arithmetic shows most of them subtract value through fees. What I have observed about Wall Street is simple. Investment banks will sell products as long as those products can be sold. Quality is irrelevant. Sellability is what matters. Before paying anyone to manage your money, identify their incentive and determine whether it aligns with your success. Something likely on your mind deserves direct treatment. I will be very direct about cryptocurrency. It is reckless, foolish gambling. The entire phenomenon is disturbing and contrary to the interests of civilization. That is a strong claim. I understand intelligent people disagree, but examine the logic. First, what is the underlying value? With stocks, you own a portion of a business that produces goods or services, earns profits, and pays dividends. With bonds, you own a promise of interest and principal repayment. With real estate, you own an asset with physical utility. With most cryptocurrencies, you own a sequence of numbers. Its value depends entirely on someone else paying more than you did. That is not investing. That is speculation. Over long periods, speculation destroys wealth for most participants. Second, consider who promotes cryptocurrency. Their incentive is price appreciation because they own it. That is not objective analysis. They are promoting their own position. Third, consider its use cases. A currency useful to kidnappers and extortionists does not benefit society. No one denies that some people have made money in crypto. Some people also win at slot machines. That does not make it a rational strategy. Those who oppose this view are not thinking clearly about fundamentals. They are driven by momentum and fear of missing out. Avoid things that are foolish, harmful, and make you look inferior by comparison. While discussing modern financial mistakes, look at what has happened with trading applications. Momentum trading by inexperienced investors drawn in by new brokerage models is deeply troubling. It is a predatory way to make money, and allowing it is irresponsible. These applications discovered something powerful. If trading feels like a video game with bright colors, confetti, and instant rewards, people trade far more frequently. Each trade generates revenue through spreads, order flow payments, and margin interest. The application benefits when you trade often. You benefit when you trade rarely. These incentives directly conflict. When one such company saw its stock collapse, someone remarked that it was repulsive and now unraveling. Watching people lose money is not enjoyable, but there is something appropriate about a company that profited from encouraging harmful behavior suffering consequences itself. If you use a trading app that makes trading feel fun and effortless, understand this. You are the product, not the customer. The company earns money when you trade. That is why every design choice encourages more trading. The solution is dull. Buy sensible investments, hold them for long periods, and ignore the noise. The correct way to think about investing reduces to one idea. View a stock as ownership of a business and evaluate the durability of that business through its competitive advantage. When you buy a stock, you are not purchasing a symbol or a line on a chart. You are buying partial ownership of a real business. That business has customers, products, employees, competitors, and profit margins. It operates within an industry with specific forces. It possesses strengths and weaknesses relative to competitors. If you do not understand the business well enough to operate it yourself, you probably should not own its stock. This is why the circle of competence is critical. Intelligent investing requires fundamental understanding of businesses. This is where many people fail. They believe diversification solves ignorance. If they own 50 stocks, surely some will succeed. That logic is backward. One of the most misguided ideas taught in modern universities is that extreme diversification is mandatory in common stock investing. That notion is absurd. Finding many clearly superior opportunities is difficult. If you have only 3 truly exceptional ideas, it is better to own your best ideas than your worst. The intelligent approach is to identify a small number of businesses you understand deeply, with durable competitive advantages at reasonable prices, and own them for a long time. 3 exceptional businesses held for 20 years will almost certainly outperform 30 mediocre businesses traded frequently. Do not buy fair businesses at wonderful prices. Buy wonderful businesses at fair prices. The distinction compounds dramatically over time. Why most people fail at investing, even when they understand these principles, has little to do with intelligence. Intelligent people fail constantly. The real issue is temperament. When markets fall 30%, every instinct urges you to sell. The news is alarming. Experts predict further declines. Looking at your account balance is painful. Selling feels like control. It feels protective. It is almost always wrong. Markets have fallen 30% or more many times in history. Every time they eventually recovered and reached new highs. Every time those who sold at the bottom locked in losses and missed the recovery. Success requires patience, discipline, and the ability to endure losses and adversity without losing composure. This is not something you can learn purely at an intellectual level. It is something you must train like a muscle. The training is straightforward, but it is difficult. When you feel the urge to take action with your portfolio, choose to do nothing instead. Write down what you want to do and why you want to do it. Then wait for 1 week. In most cases, the urge will fade. Wealthy people understand that investing is largely about waiting. It is boring. It is uncomfortable. It works. What almost no one tells you about building wealth is that it takes a very long time. Not years, but decades. The reason this is not obvious is survivorship bias. You hear about the 20-something who made millions from a technology startup. You do not hear about the thousands who tried and failed. You hear about the trader who made a fortune in 1 year. You do not hear about the thousands who lost everything. The dependable path to wealth is slow. You save consistently. You invest sensibly. You allow compounding to work. After 20 or 30 years, you wake up wealthy. That story is not exciting. It does not perform well on social media. But it is true. The people who built real wealth were slightly less irrational than most people, and slightly less foolish than most people. That helped enormously. Then they were given a much longer runway than most people because something allowed them to live into their 90s. A long time horizon is essential. The reason compounding works so powerfully over 30 years, but not over 3 years, is mathematics. Small differences in annual returns become massive differences in final wealth when given enough time. If you are 35 years old, you have roughly 30 years until traditional retirement. That is enough time for compounding to make you wealthy, even with modest savings rates and average returns. If you are 55, you have less time, but you likely earn more income. The principles remain the same. The execution simply becomes more compressed. What you cannot do is wait until 60 to start saving and still expect wealth. The time horizon does not exist. This is basic arithmetic. Here is something that may disappoint you. The principles described here are not complex. Spend less than you earn. Invest in things you understand. Avoid leverage and consumer debt. Let compounding work over long periods. Do not interrupt it unnecessarily. That is the entire system. These ideas are not hidden or secret. They are available to anyone who looks for them. The reason most people remain poor is not a lack of information. It is that simple ideas are extremely hard to execute consistently over decades. Everyone knows they should save more. Very few people actually do. Everyone knows they should not carry credit card debt. Millions of people still do. Everyone knows panic selling is a mistake. When markets crash, people panic sell anyway. The gap between knowing and doing is where wealth is created or destroyed. The real question is not what you should do. You already know what to do. The question is how you do it consistently for 30 years. The answer is systems. Automate your savings so you never see the money. Use tax-advantaged accounts so taxes do not tempt you to sell. Check your portfolio infrequently so volatility does not frighten you. Surround yourself with people who think long-term. A life properly lived is one spent learning continuously. Keep learning. Keep refining your systems. Keep executing the fundamentals. Something else needs to be addressed directly. If you attended business school or any institution that claimed to teach you about money, you were likely taught some incorrect ideas. The history of capitalism is poorly taught. How it worked and why it worked are rarely explained before teaching business operations. The foundational context is missing. Too little real-world wisdom is delivered by modern educational systems, at least in an effective way. This is not because educators are malicious. It is because incentives are misaligned. Professors are rewarded for publishing academic papers, not for teaching practical wisdom. Business schools are rewarded for placing graduates into high-paying jobs, not for teaching independent thinking. The result is that most graduates enter the workforce with impressive-sounding theories and no practical framework for building wealth. If you want real financial education, you must acquire it yourself by reading and studying people who actually built wealth by making mistakes and learning from them. The responsibility belongs to you. Waiting for someone to teach you is waiting for something that will never happen. A few thoughts on the relationship between your career and your wealth are worth considering. There are 3 basic rules for career satisfaction. Do not sell anything you would not buy yourself. Do not work for anyone you do not respect and admire. Work only with people you enjoy. These rules appear to be about happiness rather than wealth, but they are closely linked. When you work for people you respect, doing work you believe in, alongside people you enjoy, you bring your full energy and attention. You perform better, advance faster, and earn more. When you compromise on any of these elements, you contribute only a fraction of yourself. Your work becomes mediocre, your progress stalls, and your income suffers. There is an even deeper issue. When your daily work compromises your character, you develop habits that undermine wealth building. You cut corners. You optimize for short-term appearance instead of long-term substance. You become someone who makes poor decisions. Character and financial returns are connected. The habits that make you trustworthy, dependable, and honorable are the same habits that make you a successful long-term investor. Live below your means. Avoid excessive envy. Avoid resentment. Do not overspend your income. Remain cheerful despite difficulties. These are not merely moral suggestions. They are practical strategies for building wealth. Before closing, there is one uncomfortable truth that must be acknowledged. Most financial failure is self-inflicted, not all of it. Some people experience genuine hardship through no fault of their own, such as medical emergencies, economic crises, or circumstances beyond their control. But most people who remain poor do so because of patterns they could change. Spending more than they earn, carrying high-interest debt, making impulsive financial choices, chasing past performance, selling in panic, and buying things they do not understand. These are not random errors. They are predictable psychological behaviors. The human brain evolved in an environment where resources were scarce and immediate. When food appeared, you consumed it. When danger appeared, you fled. Short-term thinking ensured survival. Modern wealth building demands the opposite. You must resist immediate consumption. You must tolerate discomfort instead of escaping it. You must think in decades rather than days. This does not come naturally. It requires deliberate effort to override evolutionary instincts. Understanding your own psychology, biases, triggers, and predictable failure patterns is essential financial knowledge, more important than understanding any specific investment. Know yourself, especially the ways you consistently sabotage your own progress, then design systems to prevent that sabotage. I will leave you with this. You will never be poor again if you consistently do a small number of simple things over a long period. Spend less than you earn. Always save something. Invest your savings in sensible assets, preferably in tax-advantaged accounts. Never interrupt compound interest unnecessarily. Stay away from consumer debt and leverage. Invest only in things you understand within your circle of competence. Develop the temperament to remain calm during market volatility. Continue learning every single day. Avoid foolish behavior rather than chasing brilliance. That is the system. It is not complex. It does not require extraordinary intelligence or special connections. It requires discipline, patience, and time. Most people do not follow it, not because they do not know what to do, but because it is boring, slow, and demands delayed gratification in a world designed for instant pleasure. What I have observed about people who actually build wealth is simple. They are not the smartest. They are not the most talented. They are the ones who stayed with the basics the longest. They were slightly less irrational than most people, slightly less foolish than most people. They adopted a longer time horizon than most people. And that was enough. It can be enough for you.